Hello and welcome to another episode of Cashbright's tips, tricks, and interesting thoughts on all things money and finance. In this episode, we'll be talking about stocks versus bonds. What the hell are they? What's the difference? And the reasons why you might prefer one over the other. Now let me start by saying that this is very common and normal not to even know anything about stocks and bonds. Most of us are not hotshot bankers or Wall Street traders. You and me are just not taught about these things, and quite frankly, knowing what these things even are isn't going to help us work the 9-to-5 day job out there in the real world. So most of us are just oblivious to the world of stocks and bonds, and that's cool. But I'm going to drop a bombshell on you. Are you ready? This information barrier stopping you from participating in this world is deliberate. I'm telling you, the rich guys out there don't want you to know about it. For Joe or Jane blogs to come along, do what they do, make money, and in turn make them feel like less of a financial success? No way. They'll just say to you, forget about it. It's too complicated for you. Stocks? Bonds? Yeah, right. You need to have proper financial experience to ride the bull? Hang on though. If trading in stocks and bonds can allow you to generate real wealth for yourself and your family, why the hell can't you do it too? Well, of course you can. So, sit up, grab yourself a plate, and get ready to grab your own slice of that money pie as we begin this video by answering our first question: what is a stock? A stock is basically a type of security or property that a person holds which grants them ownership of a proportional slice of a company's assets and earnings. Stocks can also be called shares or equities and are issued by a company to raise money from the public in exchange for them giving up some ownership and control. By owning stock in a company, you become a stockholder. The more stock you own, the more of the company's assets and earnings you will earn, and the more influence you will have indirectly over the board of the company. So stocks are property that can be bought and sold at stock exchanges. A very well known stock exchange is the New York Stock Exchange, where the average daily trading value is over $100 billion. The price of a stock is determined by a number of factors and is representation of the highest amount investors are willing to pay for it and the lowest amount stockholders are willing to sell for it. With all things remaining equal, the more people want to buy a stock, the more the stock price will increase. The more people want to sell a stock and not to buy it, the more the stock price will decrease. Here's an interesting thought for you. One of the biggest factors driving stock prices is the collective confidence of investors. Think of it. If together the market gets spooked by something like, I don't know, the US president saying something bad, prices of those stocks can tumble across the board, even if fundamentally nothing in the real world has even happened. Isn't that crazy? So, stocks are a great way to make money, and overall, they have the potential to outperform almost every other type of investment. But hold your horses there. Don't dive into this murky world of the stock market just yet. Trading in stocks carries inherent risks which you need to be aware of. So take our advice and do your research. Seek professional advice, create an investment plan so that you can start making money whilst also minimizing the risks as far as possible. With the right strategy and a careful approach to investment, there is absolutely no reason why you can't start making a lot of money. Number 2. What's a bond? Bond. The name doesn't help, does it? For me, it makes me either think of a British spy with a license to kill, or like the bond between you and your dog. Anyway, despite this, a bond in a financial context just means a loan between a lender and a borrower. The difference between a bond and a regular loan is just that the lender can be you, and a company or even a government institution can be the borrower. Pretty cool, right? The borrower borrows money and agrees to pay it back after a fixed amount of time. During this time, they agree to pay you interest on top of the money they borrowed for the very privilege of borrowing your hard-earned cash. Now that sounds pretty sweet to me. Bonds are used by companies and governmental institutions to finance their operations and projects. The details of each bond will vary in relation to the amount of interest to be paid, how often payment is to be made, and the overall length of the loan, meaning how long until you get your money back. This end date of the bond is called the maturity date. The interest that you earn during the loan period is, for some reason which I don't understand, called the coupon. So like stocks, bonds can be traded in the bond or credit market. However, this market does not have a fixed centralized place like you have with stocks, so it's actually quite difficult for you and me to participate in this market by ourselves. This is why most people trade in bonds through using third-party asset managers. So by owning a bond, you will receive a steady, if not relatively low, fixed form of income over a predetermined period of time. This makes bonds attractive for those of us looking to invest our money in things like retirement plans or college funds. Now let's talk about a very important aspect of bonds, the credit rating. If you have ever seen the movie The Big Short, you will know what I'm about to talk about. If you haven't seen this movie, by the way, I cannot recommend it enough because it does a really good job of explaining how bonds and their credit ratings basically took down the global economy back in 2007 and 2008. Do you remember that time when the economy basically died and the government had to bail out all the banks and the banks just ended up getting away with it anyway? Moving on, every bond has a credit rating based on how likely the borrower is to make good on its promise to pay up. This is just like yours and my credit rating, which is assessed by banks whenever we want to take out a personal loan or a mortgage. The credit rating is given by supposedly private, independent rating agencies, such as Standard & Poor's or Moody's. Bonds are rated by these agencies using letters such as AAA, BBB, or CCC. The higher the grade, for example AAA, the lower the risk for the bondholder, in theory, and the higher the bond price. The price for a AAA rated bond is higher because naturally more people would want these bonds rather than the lower rated bonds which carry higher risk. On the flip side though, the return on AAA bonds will be lower than on riskier CCC bonds. And this is a common theme in finance. The higher the risk you take, the greater the reward. But we know things in life have a tendency to go south, and this can of course happen with your bonds. So if the borrower runs into problems and doesn't pay, you can end up losing all of your money. So like with stocks, it really is a case of buyer beware. Number 3. Which one is best, stock or bonds? Stocks and bonds are two of the most traded types of assets, but they each have their own characteristics which can be useful to you depending on what your goals actually are. Both types of assets carry risk, so unfortunately this can never be eliminated. But each can also be distinguished by their rate of return, how easy they are to trade, and how susceptible they are to market volatility. On the one hand, bonds are definitely set up to provide you with a predictable and steady form of income. In a general sense, they are less risky than stock simply because they are debt and less prone to these market fluctuations, like when investors get spooked and stock prices inexplicably tumble. However, the return on a bond is relatively low. Your money is tied up for a long time, and it's more difficult for regular people to trade in bonds. On the other hand, stocks are a more flexible form of investment which can be traded at stock exchanges and offer higher rates of return in a much shorter space of time. But stocks are more susceptible to market volatility. As a result, losses are common across stock portfolios, and these losses are very difficult for you to avoid, mostly because the market, like people, are just not always rational. So which one is best, stocks or bonds? Well, I think you will agree that it really depends on you, your goals, your tolerance for risk, and overall how you want to play the game. In our view, we think you should consider both. And as always, remember, do your research before you invest. It really is the Wild West out there, people. So remember, keep your wits about you and stay cash bright. Thanks for watching our video on stocks and bonds. To stay up to date with all our future videos, please hit the subscribe button. Until the next time.